It's Reggie Middleton experimenting with Zoom, testing everything out, making sure it works before we get started. This is going to be interesting because it is going to be a first in crypto media, and it will entail moi, me, Reggie Middleton, apologizing, admitting fault because I was wrong. But I also, because I'm doing this on my own, I need to make sure everything is working. So let's see if you can hear me. If you cannot hear me, in the chat, say you cannot hear me. If you can't hear me in the chat, please say you can hear me. Okay, let's start this out by, this is going to be awkward because I'm trying to play production an assistant and host and everything at the same time. Okay, so bear with me. And we'll discuss where I went wrong, why and how I went wrong, and how it's being corrected. Okay. Um, First of all, I'm not ready to start yet, but I do want to. Um, Sounds good. Okay, you can hear me? Thumbs up. Okay. So, first of all, apologies go out to the CEO of Coinbase, Brian Armstrong. Okay. I accused you of something that wasn't true. Okay. First of all. Second of all, I'm going to go through some facts, actual analysis. Okay. Now, Mr. Armstrong may or may not like all of it, but it's going to be factual. And to begin with, I want to make it very clear. My apologies go out. The last thing I definitely want to do is spread FUD. Okay. I'm going to send invite out link out to the Telegram members. Give me 1 second. The live chat, live participation in YouTube as well. Now, this is risky because it allows idiots to join, and I can't screen them and speak at the same time. So please, no idiots, okay? Zoom link. Random assistant, right? Okay, so this is what happened. I accused Coinbase of rehypothecating. Okay, and the rehypothecation accusation was not meant to be malicious or spreading FUD. I had a very strong reason to assume that because Coinbase was taking in USDC on their platform and offering a yield for it. They called it a reward. In order to generate yield, you have to assume risk. That was an assumption on my part. Okay. As it turns out, with little deeper dive research, it was an invalid assumption. So we're going to go through this on a deep dive. I'm going to try and share my screen, and we're going to hopefully educate as many people as possible. Okay? So to begin with, let's go through the original. Let's go through the original, and there are people in the waiting room. I'll bring you out of the waiting room into the live stage after I go through the background, and then start explaining where we stand right now. So the background is you have Circle, which issues USDC. by taking in capital, usually US dollars, and issuing tokens, usually USDC, always USDC or US Euro, I think they have now, usually on the Ethereum blockchain, but on certain others, such as Hedera Hashgraph, Polygon, etc. Circle's business model is to take that money and invest it, keep all the yields, and give the USDC holders nothing in return other than the USDC tokens, which can move along the blockchain rails, hence are much more liquid, malleable, transferable, auditing through the blockchain, et cetera, et cetera. The problem is this stuff is now much easier to use than traditional fiat and the traditional banking system, but it also has what I've coined as return-free risk. You take the risk of Circle as an operating entity, Circle as a counterparty, Circle as a very, very bad credit risk. Circle is a junk rating from our perspective, highly speculative. And you take Circle's investment risk as well when they invest your assets. What do you get in return for all that risk? Big fat zero, nothing. Hence, return-free risk, risk without a return. Risk is the cost of reward. The reason you take risk is to get a reward. You're getting no reward, but you're taking the risk anyway. Investment reward, at least. The reward that you're getting is you're getting these tokens. Much better way to do things, in my opinion. But discussing Circle is another conversation. Coinbase is a partner with Circle. They are a reseller of USD tokens. That's why they push USDC tokens so much on their website. Okay. Now, in pushing these USDC tokens on their website, they are relatively aggressive. Give me 1 second. And in that aggression, and I'm going to say aggression, but not a negative contents because they do have a business to run, they try and get as many people to use USDC as possible. So they try and get as many USDC users as possible. They do this by offering discounts. They do this by waiving transaction fees, marketing, and offering the yield, the aforementioned yield. That aforementioned yield is essentially a sharing of the investment gains that Circle enjoys. So as a reseller partner, this isn't another assumption, but this one I would assume is valid. As a reseller partner, Circle is able to, Coinbase is able to get a cut of the investment gains that they bring Circle by bringing more USDC in, okay? Or more USDC customers. That's where that 1.5% yield comes from. It's still minuscule considering that a 1-year treasury is yielding over 4%, if I'm not mistaken, and even 30-day treasury bills yield more than that, or a lot. I haven't looked up specifically, but up to 1.5% is probably somewhere around, depending on where the up to falls in the scale, 33% of the risk-free rate, which is the highest quality, lowest risk interest rate you could get in the US. Okay, and that's the US Treasury. So very, very meager return, okay? Still risk. Now we're going to quantify the risk and we're going to go through, I explained how I made the error. I assumed that they were actually investing the USDC that they brought in. I use MakerDAO as an example. And let's go from the beginning. MakerDAO is a stablecoin DeFi platform, smart contract driven. algorithmic platform, algorithmic stablecoin. They have significant profits. They took the $1.6 billion of USDC that they got from their DAI operations, and they gave it to Coinbase through a vote, governance token vote, where Coinbase is a significant voter apparently, and so are the investors who invested in Coinbase. They convinced Coinbase Coinbase convinced them to give Coinbase $1.6 billion to go on their prime desk, okay, in exchange of which they will offer them up to 1.5% APY and some autonomy in minting the tokens, et cetera, et cetera. This is the issue, though. I thought they were reinvesting these USDC, hence rehypothecation. One set of collateral, the dollars that went in, 2 loans. They weren't reinvesting it. They were splitting income from the original investment with the token holders. That's good. That's creative. My apologies once again. But here's the rub. You are taking the risk of Coinbase as a counterparty and the credit risk of Coinbase, in addition to the risk you're taking with Circle. Now, we're going to walk through this risk. Circle had an ongoing concern warning from their auditor in 2021, I think, 2020. That's accounting financial parlance for they were likely to go out of business. They got investments. Those investments pulled them out of the ongoing concern risk, and they took an accounting loss of greater than the amount they were invested by the end of that calendar year. Okay, which means Circle has a real profitability problem. Negative real rates, very low nominal rates, lots of volatility risk pushed Circle into that. Rates have skyrocketed up. That has given Circle more operating margin. Okay, so it's taking the liquidity issues away from Circle, or at least modifying them. But Circle is still extremely, extremely risky. One of the biggest risks, right off the top of my head, is IP infringement risk. It is my belief that Veritasium wields the patent that covers almost all of Circle's businesses, especially their primary revenue drivers. Again, a discussion for another day. Coinbase has very similar issues. They don't have a liquidity problem. They have a decent amount of capital on their balance sheet. I think by the next reporting cycle, they should have roughly about $4 billion. That seems like a lot, but it was 7 billion, 6 or 7 billion a couple of quarters ago. They're eating through $1.5 to $2.25 billion a quarter. That's negative cash flow and burn. Okay, they've cut down expenses, which means they've eliminated or they've cut down the potential rate of growth, but they're also cutting down the burn. Coinbase essentially only makes money when Bitcoin goes up in price, and they lose money when Bitcoin goes down. Oversimplification, generalization, but it does get the message across. Okay, Coinbase has very, very, how do I put it? Coinbase has a very, very risky credit profile. Okay, now I'm going to share my computer and I'm going to show you exactly what I mean. Okay, let's see if this screen share works. And we are going to go through examples of how this would work. You want Signal, have to figure this out. Tweet Google Chrome. Share. Give me 1 second, everybody. Let me figure this out. Make sure it's sharing. And you get to see my perspective on Coinbase as I pause and okay. So this is a slide prepared on Coinbase. First, let's make sure that everybody can see the screen. I will find out if everybody can see the screen by bringing somebody on board. Okay. Tim Clark in. Okay. Tim Clark, can you hear me? Unmute your mic. Speak up. Okay. So we're going to make an assumption everybody can see the screen. If you can't see the screen, you will see an example of how, well, first of all, here, Veritation Capital lawsuit filed September 22nd. So first of all, we have a patent infringement litigation issues, which is real, actually. Pardon me, I want to make sure it's available. Okay, so you have the patent infringement issue with Coinbase. It is my personal opinion that the infringing products and services that do infringe on a patent, and again, this is not adjudicated fact, this is my personal opinion, it covers the vast majority of Coinbase's revenues, right? Significant risk, significant risk. Okay, if you understand how patents work, patents give the patent holder the right to exclude if infringement is actually going to be found. If you can exclude Coinbase or exclude the vast majority of Coinbase's revenues, that's a big, big no-no for shareholders and stakeholders, number one. Okay, number two, the equity markets think similarly of Coinbase. They have lost roughly 80 to 90% of shareholder value since IPO. Okay, again, very, very negative. The credit markets think similarly of Coinbase as well. Okay, you have yields between 13 and 18%. The bonds have dropped roughly 45% in price, and Coinbase's bond yields have inverted. The short-term bonds are yielding more than the long-term bonds. Okay, and they're deep into junk status. Okay, now let's look at it from do, 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 do. Let's do, from a perspective. Was the market's perspective. Let's look at Moody's uh, opinion of Coinbase. So Moody's rated Coinbase BA1 and BA2, or BA2 and BA3. That was a speculative rating, okay, meaning that the subject has substantial risk. So BA means substantial credit risk. 1, 2, and 3 are modifiers, where 1 is better than 2, and 2 is better than 3, and 3 is worse than 1 and 2. Okay, so they were rated as BA2 and BA3, and they're currently under review for a negative downgrade, which means they're going to, at best, if they were to be downgraded, B1 and 3 at best. When you get down to the B ratings, it's considered high credit risk. Now, the whole purpose of doing business with Coinbase through USDC for MakerDAO, presumably, is for safety. The reason why you go into a stable coin is because you want stable asset value, stable principal amount, and you're looking for a return of your capital. Not so much a return on your capital, but a return of your capital. If someone told you, I'm going to give you this token, I'm going to save you this token, you give me dollars for a token, I'm going to give you a token in return. But that token will have high credit risk, a high risk of failure. Would you consider that a stable token or a safe investment? That is what Moody's is telling me. Okay. I did not look up the default rate for B-rated speculative bonds or bills, but a cursory glance gives roughly 3.5% to a 22% default risk. even at 3.5, it is very, very high. Okay. Think of 3.5% of $100. Every $100 taking a loss, up to 22%. The amount of recovery is something that has to be researched, but the general principle or basis is that you are taking either high credit risk or a substantial credit risk in doing business with Coinbase. MakerDAO has taken their USDC off of a decentralized platform where they have full control, sent it to a substantial or high credit risk entity in exchange for up to 1.5% return. This return is one third of to significantly less than 1/3 of the return that they get if they put their capital into the highest rated credit risk in the US, which is Treasury bills. So exactly what is the motivation? What is the purpose of taking this return-free risk or minimum return risk? That's a question to be answered for another day. Okay, so I was wrong with the rehypothecation. Coinbase is not lending one set of collateral twice. I admit my error. I explain how I made the error, and I apologize. What is evident is the substantial or high credit risk of Coinbase and doing business with Coinbase, the intellectual property risk or the patent infringement risk of Coinbase. Coinbase is currently in litigation. They were filed and served with a complaint through the courts. They filed a motion to dismiss. That motion to dismiss was opposed. They now have the opportunity to reply or to answer the reply to the motion to dismiss. In my opinion, personal opinion, again, I'm not a lawyer, okay? I'm not even a smart technical guy. I'm just a dad, hopefully a humble dad. But my belief is, as a layperson, that motion to dismiss opposition was very, very, very strong. And it shows how strong and powerful the patent and the allegations are. To add to this morass, USDC, stable coins, and asset-backed tokens are also covered under the same patents that our Coinbase is being brought to court on. So there's a lot to consider. Now, let's take a look at, and I'm going to have the people come on stage. I'm bringing people into the stage and into the waiting room. Just let me go over these facts, and then we'll have a back and forth conversation. Okay, so this slide shows the layered, uncompensated risk of today's stablecoins, Tether, USD, and BUSD. Not necessarily picking on these. I just pick what I consider the top three. Okay, layer risk, layer one, the coin issuer's credit and counterparty risk. Okay, whoever issues the coin has operating risk. Okay, if these are startups, then you usually have significant operating risk. The startup failure rate itself is significant, just off the bat. The startup failure rate in the crypto industry is significantly higher. And then you have all the other risks, regulatory risk, et cetera, which we will go over in the next slide. So layer one, coin issuer credit and counterparty risk. Coins are only as safe as the issuer, okay? USDC through Circle has a going concern warning, solvency issues. Their profitability should have increased significantly. A lot of entities probably rushed into USDC with the FTX and the Celsius blow up and Voyager and everybody else. And at the same time, so their addressable market has increased. And at the same time, interest rates have went up 400%, 300%. Okay, so that's a big positive. Okay. Another negative, rampant patent infringement issues throughout the entire industry. Not picking on USDC itself, but throughout the entire industry. Layer two risk, coin reserve quality risk. So the lower the credit quality of their assets, the longer these assets or these investments duration. And duration is basically the amount of time it takes to recoup the investment asset from yield, and asset liability mismatch, which is what blew up Celsius and Voyager, or risk that you take in the reserve quality. Okay. Layer three, coin reserve custodian Coin, that's a tongue twister. Coin reserve custodian counterparty risk. Everybody who touches these assets become either a counterparty or part of the daisy chain for risk. Everybody who touches the assets. You're exposed to the bank, the brokerage, the trust holding, the backing assets, everybody who touches this chain, which is why you want as few participants and middlemen as possible. Rampant patent infringement risk issues or perverse throughout the industry. For instance, many methods of cold storage infringe on these patents. So you see how it gets layered, layer after layer. So what I decided to do was create, and anybody looking at this video, look at it over again, screenshot this and screenshot the slide before it, because it gives you a much more realistic view of the risk. Okay, so the center circle, the key crypto entity credit risks. Okay, these are the credit risks, the key credit risk of crypto entities, which are different from traditional operating entities, particularly in the finance space and the fintech space. And I'll admit they're different. A lot of people think valuation is different. Listen, money is money. Comparative valuation is comparable valuation. DCF is DCF. Okay, 1 + 1 is going to equal 2. It doesn't matter what industry you are. You just have to know where to pull the ones and the ones from to get to the 2. So the big circle, key crypto entity risk. Again, I have this as the largest one, not to be self-serving, but it is the least recognized risk, and that's patented IP piracy and infringement. Okay, you risk injunctions that can lock you out of the industry, adverse judgments, etc. On the worst case scenario. On the best case scenario, you have lower margins. Now, this can serve as a positive because the entities who created the IP and patented it, if you work in conjunction with them, they can expand your product offering. They can mitigate risk for you. So instead of being a source of risk, they're a shield of risk, etc. That takes a change in management mindset. Okay. And with that change in management mindset, you can have an industry that grows as fast as any other patent-heavy industry. Examples are smartphone industry, from close to zero to one of the largest industries in the world in like a decade. Okay, a little over a decade. That's one example of many. So next big circle is operational execution risk. You can't have a bunch of 30-year-olds running $27 billion companies with no grown-ups in the room, or you'll get the results. We're not going to go through who that may represent because they're all over the news right now, but that's an example. Protocol smart contract risks. Okay, these are risks that are not prevalent in most traditional fintech concerns, but they're definitely an issue here. A good example would be Solana, which goes down regularly. Okay, another example would be the exploits available in blockchain bridges. Okay, when you bridge one chain to another, that is a point of weakness, a lot of exposure, and it's been hit often. DeFi legal structure uncertainty. When people put together DAOs, okay, they leave themselves open to significant liability. I've made several videos on that, and I've harped on that ad nauseum. And then the CFTC came in and is attempting to prove the point for me. So are other patent holders serving DAOs. CFTC served DAO through the DAO through their help bot. There's some pushback from amicus brief participants, amicus curiae. I haven't been following that closely. I don't see the judges decide. I don't know if the judges decided on it, but a lot of that could have been avoided with a little more traditional forethought. Asset liability mismatch, Celsius all the way, Voyager. Usually you have short-term assets with long-term risks, and that's not a good idea. Having to roll those assets over usually increase the asset liability mismatch even more significantly. And you need to match your liabilities with your assets. Okay, so you don't want to make a sharp turn with a large Mack truck. Even if you have the Mack truck, it can be worth a lot. If it can't make the turn, it can't make the turn. Bad analogy, but I'm in a rush and I'm ad-libbing. Okay. Regulatory uncertainty that hit even us. And we're supposed to know what we're doing. Okay. The SEC is basically taking Veritasium out. It was reborn as an IP lab, but we had a lot more going, which is how we were able to invent a lot of the stuff that we patented. Okay. The SEC, as is well known throughout the industry, is on a warpath against crypto in general. Regulation through enforcement versus rulemaking and regulation, amongst other things. Okay, CFTC, are these things commodities? Are they securities? Are they other, etc.? Operational third-party operational risk. Just think of Circle and Coinbase, and third-party dependencies. Let's think of Gemini, who relied on Genesis lending to provide their yield product. And so when Genesis lending had to suffer from Celsius and FTX blowing up, they had to pull back and put a gate on their withdrawals, and they powered the withdrawals for Gemini, who then had to put a gate on their withdrawals. Once they put a gate on their withdrawals, everybody got nervous, and they pulled almost $1 billion worth of capital out of Genesis, out of Gemini's regular transaction and trading platform, because they were concerned about the much smaller, if not quite de minimis, lending platform. Your reliance on third parties might increase your efficiency, but it also increases your risk accordingly. Okay, operational risk is also rife because only very recently has mature executives and operation managers come on board. And you still have people who are heavy on a technical perspective, but light on a managerial and financial perspective, and a lot of young people there. I'm not young anymore, but I do realize that the only way to get experience is to experience it, and it takes time to do that. Okay, so you have to understand where your limits are when you're 20, 25, and 30 years old. No matter how smart you are, no matter how much of the kind you are, you've still only been around for 30 years. Counterparty risk and contagion. That's self-explanatory and hits everything. Do realize that if you take the protocol smart contract risk, the asset liability mismatch risk, and you use that to consider the counterparty contagion risk, you might not be able to eliminate contagion, but you do eliminate the counterparty risk. And you simply turn that into protocol smart contract risk and execution risk. The whole purpose of DeFi is to eliminate counterparty risk, to eliminate reliance upon an authoritative third party. Guys don't get it. I don't want to be rude, crude, or mean, but if you lost your money at FTX or Celsius or Voyager, you had it coming. I can understand losing capital that's waiting for a market, for an order to hit, a limit order to hit. Okay, but if you started and use these unregulated shadow banks as regulated open banks, you realize there were unregulated shadow banks and you lost your capital. I know I sound like a traditional finance guy, but you know why? Because it's the truth and it's a fact. And I am a traditional finance guy. I'm also the guy that created advanced DeFi, so it's not as if I don't know what I'm talking about on the crypto side. So it's time for the industry to grow up. Okay, liquidity and volatility risk. Self-explanatory. Volatility, a lot of these assets are very volatile. You know this, right? Prepare accordingly. If you take open volatility risks, don't be shocked when it catches up to you. There's no need to do it. There's enough profitability in there to profit and hedge against or avoid volatility. Liquidity risk is a risk, but is often misstated and misused. Throughout the last 4 or 5 months, 6 months, almost every time I heard the media crow about, or crypto entity complain about liquidity risk, what they really meant and probably didn't want to say was this was a solvency issue. Liquidity wasn't the problem, solvency was the issue. So if you have more liabilities than assets, you're insolvent, right? If you have more expenses than positive cash flow, you're insolvent. Either balance sheet insolvent or cash flow insolvent. That has nothing to do with liquidity. Just keep that in mind. Traditional finance style cybersecurity, it is what it is. That should be intersected or overlapping the protocol smart contract circle. Maybe I should move this around and redesign it so these risks which overlap can be seen more readily. Okay, we're going to go over these last two slides quickly. This goes through what I assume was rehypothecation on Coinbase's part. Again, Brian Armstrong, my apologies. I do not do FUD, I do facts. I have enough facts to go over where I don't need the FUD. If I make a mistake, you have my apologies. There you go. I'm going to apologize 4 times. I think that's enough. And this goes over rehypothecation. Okay, so we're going to stop sharing my screen and we're going to go and bring these participants in and we're going to have them ask questions. Okay. Admit. Please, everybody behave. Okay. And let's get the volume up. And unmute your mics and say something. Up. You got up and left your screen. He got up and walked away. There you go. I can't hear you.
Hey, Reggie, can you hear me? Can you hear me now?
Twice and say something. Oh, that's Trey. Okay.
Hey.
You got up and left your screen. You got up and walked away. There you go.
Can you hear me now, Reggie?
I can't hear you.
Hey, Reggie,
yes, I hear you now. Go ahead.
Can you hear me now?
Yes, I do. I actually hear you through my phone. I'm having technical difficulties, but we'll solve it.
Yeah, I've got a little feedback on my side. Let me shut off the.
Yes, I can. Go ahead.
So maybe that's better. Can you hear me now? Is that a better reception?
Okay. Hold for 1 second, Trey, because there seems to be a delay. So I hear you from the phone. There's something I need to adjust in here, apparently. Let's see what it is. No, absolutely no idea why I can't hear you through the computer.
All right.
Okay,
so let me know when you can hear me.
Put up with the delay, Trey. Go ahead.
So a friend of mine and I were discussing the counterparty risks and stable coins. And he was asking your opinion about stable coins and which ones we should use in our interactions with crypto. And I told him that you recommended the US dollar as the best stable coin. Can you expand on that thought a little bit further? We're discussing the counterparty risks and stable coins. And he was asking your opinion about stable coins and which ones we should use in our interactions with crypto. And I told him that you recommended the US dollar as the best stable coin. Can you expand on that thought a little bit further?
Okay. So I'm going to answer that question. I have to listen to you through the phone because I'm having a glitch here. So there's a delay. But the reason why I said the US dollar makes the best stable coin, US dollar stable coin, is because you have a problem with the stablecoin business model. Okay, and to give some credit to Coinbase, they went into the correct direction in solving that problem. This is how stablecoins work, and I explained it earlier. They take your money. You give them Coinbase, let's say MakerDAO gives USD Circle $1.6 billion. Circle gives MakerDAO 1.6 billion USDC. Okay, they take that $1.6 billion, they invest in the 3-month treasuries. They get, say, 4% off of that $1.6 billion if they roll those treasuries over 4 times for the year, 4% annualized. Okay, 4% on $1.6 billion is a lot. We're talking roughly what? 6.4, $64 million. That's not bad. Okay. How much money do the USDC holders get out of 64 million? Nothing, 0. So you're getting, again, the risk of doing business with CoinDesk and the reward of 0, return-free risk. Okay. The stablecoin issuer is incentivized to take as much risk as possible because the more risk they take, the higher their revenues. And since it's not their money, it's like having a built-in call option that you don't have to pay for. They get all the return, they take none of the risk. That is a perverse incentive. And that's the problem with stablecoins, the stablecoin business model as it's currently implemented. Now, if Circle blows up or even has a rumor of blowing up, they can't get anybody to give them any more money. So there is an incentive either not to take as much risk or to hide the risk that they take. The incentive to hide that risk, again, is a perverse incentive to the customer. The best way to structure an asset-backed stablecoin, in my personal opinion, is to take make the issuer a separate entity, make the assets held off balance sheet of the issuer, right, in segregated accounts. And so the issuer has very little control and no ownership, and all the capital is bankrupt remote, which means in the case of a bankruptcy, it can't touch the capital of the USDC issued tokens. A, and B, a creditor such as a patent holder who successfully sues Circles and gets paid won't be able to take the capital from the USDC token holders' reserves. It comes directly from, let's say it was Circle's operating capital. That's not the way things are put together, as I understand it. Okay. B, why have money if you can't get a return on your money? Return-free risk is not good. What you want is a risk-free return. That's what they call treasuries. In my opinion, there's no such thing as a risk-free return because risk is the price you pay for return. But treasuries are the closest thing, at least according to business school. So the stablecoin business model should also allow for return. Now, you can't do that the way it's currently structured because that return is what gives profits to the stablecoin issuer. Okay, now the stablecoin issuer can split the return with the stablecoin holders, and that's what Coinbase is doing when I thought they were rehypothecating. But that split is minuscule, particularly considering the compounded risk. Because the way Coinbase is now doing it, you have the risk of doing business with Circle, the issuer. You have the risk of investment, whether it's commercial paper through Bitfinex, super risky, or treasury bills, not so risky. And you have the credit risk of Coinbase, super risky. Two super risky, potentially three super risky, or the third one could be not so risky endeavors. One return. Again, not worth it. So you have to revamp the way the stablecoin business revenue model is put together. I can do it, and anybody else who's well-versed in financial engineering can do it as well. Do they have incentive to do it? Currently not, because people are very happy taking return-free risk until you get another blow up. And then you're going to hear people say, but who would have known? And we could have never known. And nobody ever listens to Reggie. Okay.
Reggie,
So I'm
can
going
I
to turn the
follow up?
volume up. Ask a question, and there's going to be a delay before I answer because it's going to go through YouTube. But I'm going to listen for it as I'm trying to figure out why I can't get any volume. So
all right, my follow-up, my follow-up is this. In my background, you can see the VE Silver and VE Gold tokens that you created on the VE Veritasium platform. How about taking all of the counterparty risk out of it altogether and backing a stable coin with a 6,000-year-old history of silver and gold? Would that be a viable option that would be beneficial to everybody, knowing that that stability has been recognized over thousands of years?
I fixed the problem, by the way, so now I can talk in real time. Just to make sure, answer my question. Can you hear me? Hello?
Did you hear my question?
Yes, I did. Okay, I just want to make sure I fixed the problem. So the concept of a stable coin is a misnomer, or that's not true, but as it's applied, it's a misnomer because most stablecoin buyers don't want a stable coin. They want a coin that tracks an unstable asset like the US dollar, okay, or like gold. So if you had a stable coin, its value would remain relatively stable relative to many other assets that it's traded with. A lot of people wouldn't like that because the price of that will shoot up in certain scenarios and shoot down in other scenarios, usually relative to fiat currency, and will drive people crazy. But it will be stable and predictable. So assets such as VE gold or VE silver tied to and backed by precious metals such as silver or gold would be stable to the price of gold, but it would be unstable to the price of fiat. That, depending on what your objectives and goals are, would be very good over time because that instability would result in an increase in price as long as it's priced in US dollars, euros, yen, or pounds. Okay. But short term, you would have some volatility. So it all depends on what your goal is. If it's long term capital preservation when priced in fiat, government issue fiat currencies, that will work perfectly. If it's true stability, gold is still volatile. And if it's day-to-day transactions, it's quite possible that that will drop in price or value relative to fiat on a day-to-day basis. Like gold has some volatility on a day-to-day, quarter-to-quarter, even a year-to-year basis. Once you break 5 or 6 years, definitely a 10-year period, gold outperforms all fiats because fiats are debased purposely by model. That's
Yeah.
a long-winded answer.
Well, I was thinking about, the make or die model is to over collateralize the token with Ethereum. Couldn't you over collateralize a stable coin backed by silver and gold and still peg it to a more traditional peg like the US dollar or the yen or the ruble?
You definitely could, and it would be a lot cheaper because the reason why they over collateralize with Ethereum is because Ethereum is native to the Ethereum blockchain, very convenient and easy. But Ethereum's volatility creates the need to over collateralize. And even with the 150% over collateralization I think they had in the beginning, it still broke the buck and they had a problem maintaining that peg because the algorithms couldn't exchange and buy and sell the Ethereum fast enough to maintain the peg. And you had what effectively was margin calls, which couldn't be executed. If you use gold, silver has a decent amount of volatility to it. So something a little less volatile, it's like gold. If you had gold, then you would not have, at least using historical performance, you would not have that volatility issue. But remember, historical performance is not a guarantee of future results. So yes is the short answer to your question. Okay, let's have others come up. Okay, Trey. R boy and or TC38. Let's jump on and talk to us.
Our boy is having problems with his microphone. In the chat, he asked, would the BRICS model for commodity-backed currency be more stable relative to their fiat? More commodities make a slower and more general backing.
Well, when you say their fiat, because a lot of the BRICS have volatile fiat. So it may, I have to run the numbers because now I'm guessing. I've ran them back in 2018 when we actually created a stable token that was truly stable. And it's had as components oil, palladium, silver, gold, copper, US dollars, euro, yen, etc. And we used math to see what combination of these created the most stable price over the last 6 months, year, 2, 3, 4, 5 year period, a decade, 20 and 30 years. We focus on the 6 months to 2 year period. And that's how we tuned the model. And we created a token that was backed by redeemable physical assets that was stable. There was almost zero demand for it because, again, people didn't want stability. So back to the question of the BRICS, relative to the member countries of the BRICS and their fiats, it's quite possible you can do better with commodities, but part of the reason why they would do that is because they have very, very weak fiat currencies. Examples, and then I remember the BRICS, but examples would be a lot of the African currencies, the yen, not the yen, the yuan, Brazil's currency, the real, etc. So comparing BRIC currencies with the major fiat currencies of the world, such as the dollar, pound, euro, the franc, and the yen, are two different conversations, really. Okay. Um, TC28. If you have anything to say, just jump on board.
PC98 asks, is there any news regarding patents in any other jurisdictions?
There will be news soon. Not yet, but I do believe there will be soon. And when there are, and it's appropriate for me to discuss it, I will. Okay. Yeah. Unfortunately, I don't control patent offices. If I did, then I have 43,000 patents right now, but I don't, and hence I don't have 43,000 patents. But I'm optimistic and hopeful, and I try to be realistic. So if I'm optimistic and hopeful, then there's a reason for it. Okay. Anybody else? Actually, there are a lot of participants. I should actually let them in, right? What to do?
Hey, Reggie, while you're doing that, can I ask one more question?
Go for it. As long as you're the only one on stage, you can talk ad nauseum.
Okay. So recently there was an article in the NewYorkFed.org website that said that a lot of banks that are participating in the Asian market, which many of them have cited your patent, are participating in a trial run of delivery versus payment and payment versus payment in Asia right now. They're settling multi-billion dollars, maybe up to trillions of dollars in block trading as well as payment settlement every day. The very Dow did a very comprehensive analysis of JP Morgan coin and proved that their digital arm Onyx, which was bought by Joe Lubin, was settling billions of dollars bank to bank in Asia as of October 2020. How big is that market, and how much infringement on your patents do you see going forward from the big banks, even the banks that have already cited your patents?
Well, the big banks are probably the biggest markets, depending on how you define and qualify banks. They're most likely the biggest consumers of the IP. The what you call crypto industry is relatively minuscule, but we're starting there because this is a very hefty research and analysis project. Most people think it's not, it's legal or it's, something else, but, this is an intersection of economics, finance, cryptography, and technology, um, and on a global and cross-jurisdictional geographic basis. It's not easy. So I've been looking at the stuff in Asia. There's a reason why I focus on Japan, but I'm also looking at other markets such as China, EU, UK, etc. And it's significant, just like it's significant in the US as well. Um, I don't want to discuss too much, but we are looking very heavily at the banking industry in general, or let's say the fire industry, or the fire sector. So that would be finance, insurance, and real estate. Okay, we're looking very heavily at it.
Joe Lubin's just down the block from you. I mean, you could probably take a stroll up to his business and knock on his door.
I probably have to jump on a bike. It's a long walk, but I know where he is. Joe knows me. Hey, Joe. Okay, I just admitted somebody else to the waiting room, so to prevent Trey from dominating the conversation, go ahead and speak. Until then, Trey, dominate on. Sing a song.
So, are there any other projects that the Veritasium Capital or Veritasium is undertaking right now that you can make us aware of? I know that you're probably doing several different projects right now, as well as fighting the legal battles that you're fighting. Are there any other projects that you can disclose to the community right now that would be of interest to Very token holders?
I'm sure there are things that be of interest. I can't discuss them now. one very important lesson I learned in my battle with the SEC enforcement unit is I talk too much. And many things you say innocently can and will be used against you. And I've had enough of that. So when things are appropriate to be said, I will say them. I'm sorry for the good guys and the good actors out there, but the bad actors cost me much too much money in turmoil. Okay.
Well, let's circle back to your analysis of USDC. It's been alleged that Tether is backed by treasuries, either treasury notes or treasury bills, to the tune of about 80%. Is USDT a more robust stablecoin than USDC? Because obviously there's a lot of counterparty risk with USDC. You've proven that with beyond a shadow of a doubt. Where do people go that have capital and want to invest in the crypto space besides the US dollar?
Well, I would doubt that there's a material or not material. I would doubt there's a significant difference in the credit profile of Tether's holding company or corporate operating company and USDC or Circle. I doubt so. It's really similar business models. There are some differences. Circle tries to get creative, so has Tether. But the um, pathology in the revenue model is the same, from my opinion. I know there's strong indications that Tether's um, use commercial paper from Bitfinex in their reserves. That would be disconcerting because Bitfinex is far from a AAA credit risk, but it's understandable. And they pulled it off. And to Tether's benefit, and you don't hear this in the media, during the Circle Luna debacle, they managed $10 billion in redemptions and didn't skip a beat. Nobody seems to want to discuss that, but it worked. If it ain't broke, don't fix it. But the problem is, we really don't know if it's broke or not until you get a significant drawdown of reserves. So 10 billion out of 80 billion is, do the math on that for me, right?
15%.
15%. Okay. 15, 16. When you get to 80, 70, 80, 90% drawdown reserves, if they do that without a beat, they did a very good job. I can tell you right now, go to one of the best rated commercial banks out there of similar size, $80 billion worth of assets, nominal, and have them do a 16% cash out within days. Boom.
They're in trouble. Yeah. Yeah.
So
Is it because of the fractionalized reserve requirements of banks? Is that the biggest counterparty risk? Is that they've lent out more money than they actually hold? And if so, is there a similarity between centralized exchanges and the current stablecoin iterations?
well, when I don't get a lot of sleep, it's difficult to follow compound questions. So I'm going to try, but it's easier like one at a time. That way I'm not straining.
Right.
Number one, it's not a reserve there's not a fractional reserve requirement. It's a fractional reserve option. They opt to do that because they increase the efficiency of the capital use until, of course, it goes bust, and it's more profitable. So that's why banks engage in fractional reserve lending and operations, because it allows you to make more money. It's basically what I accuse Coinbase of wrongly. Collateralize once, then twice. And it's a way of creating money. The money center bank system actually creates money. So it's not just the Fed and the Treasury that creates money. The Treasury just prints the money. It's the central bank that creates it, but they empower money center banks, that concentric circle around them, to create money as well through fractional reserve lending. The risk fractional reserve lending is not risky until you get to the peripherals, that black swan event or the fat tail event. Then, the tail risk, then it gets risky. And it's a matter of probability. If there's only a 3% chance of blowing up, and if you operate in that 97 percentile with that much profit margin, and your pay is predicated upon profit, you're gonna roll the dice every time. And hopefully you don't crap out and hit that 3% while you're in the CEO spot. But if there's a 3% chance, sooner or later, with 100 rolls of the dice, somebody's going to hit that 3%. So it's a reality. And it's to say, I don't believe in fractional reserve banking. I can understand that, but without fractional reserve banking, you cut down the potential and actual money supply significantly. And there's a lot of things we can't do. So there's a plus and a minus to everything. There's a plus to fractional reserve banking, and there's a minus to it. I think you could cut down the risk without reducing the reward by eliminating captured regulatory agencies and by requiring basically minimum liquidity, solvency, and reporting um, rules for any entity that is both centralized and holds material customer assets. If you did that, you would have found out what happened with FTX immediately. Okay. And also take partisan politics out of it. Everybody want to jump in and speed up on SBF, and I'm probably the only one to say this, and FTX. And, they obviously did things wrong, but they're a Bahamian company. Okay. So you don't rush to increase regulation in the US when a company in another country blows up. That's like, look, there's poisoning in the largest fast food restaurant in China, in Beijing. And then you will come down and break the necks of McDonald's in the US.
Yeah,
That's not what happened.
the pushback on that though, Reggie, is that FTX US took US customers' funds and gambled with them through a backdoor at Alameda Research. So you're taking somebody's life savings and gambling on a bet that went bad. Where were the regulators? Where was the SEC? Where they were having meetings with FTX months before the collapse?
Well, I don't know all the facts, okay, but according to Sam, he says that FTX US is fully solvent and is actually able to start allowing withdrawals. That's what he says. Who knows what the truth is? A.
Right.
B. Where was the SEC? They were finding Instagram models, pretty sexy Instagram models, but Instagram models nonetheless. They were also, beating up on Veritasium and suing Ripple and putting LBRY out of business. They have God's work to do. Okay.
Sad. Our boy has another question for you. I think his microphone is malfunctioning. Would the most
before we go on with that, is there anybody who wants to join the conversation live on camera? So I want to give a little more diversity in questioning. Okay. I'm going to put the Zoom link out in both the Veritasium Telegram group and on Twitter. And I'm also going to ask, I might be here for a while because I have to right my wrong. Now, oh, by the way, when was the last time you have heard somebody apologize for being wrong on Twitter or crypto media to begin with?
The last time I heard it was when the Very Dow did it.
Okay, not gonna see a correlation there. So
there's some grown-ups in the room, in other words.
So everybody's wrong. Actually, most people are wrong most of the time, and admitting it is not going to kill anybody. Okay. 1 second, let me just type that in, and then I'm going to see if I can give you admin privileges so you can assist me on this. Okay.
Sure.
And in the meantime, anybody has a question and I admitted you to the room, come on up. If not, Trey, can you read whoever's question?
Yeah, our boy continues with his question. Would the most sure way to make something less volatile in a fiat be to lower its value relative to the value of the backing commodity? Does this miscreate that incentive to sue the collateral for other purposes returns? The USDC story. Specific question, would the VDARE allow someone to wrap a gold bar and then lend against it, or is there some custom code required?
Okay,
I don't
I'm
know.
not
I
sure I
100%
understand
understand
that.
that.
Yeah. Let me here,
Maybe
read it again. Let's see.
specific
Uh,
question, would the VDARE, the Veritasium VDARE allow someone to
Vader.
wrap, yeah,
Vader is
Vader,
how you pronounce it, but go ahead.
yeah, thank you, to wrap a gold bar ounce and then lend against it, or is there some custom code required? I think he's talking about collateralizing a loan with a digitally wrapped gold bar.
Yeah, the Vader did allow for that.
Okay.
Okay.
TC98 asks, from a macro point of view, do you believe that the inflation rate can be tamed down in Europe or the US? First question. Follow on is, or do you think inflation is continuing to increase?
Okay. Well, the topic of inflation is not binary. Um, so the cause of inflation is, from my opinion, highly contributed to by um, structural issues. The war in the Ukraine with Russia caused energy supply issues, okay, which drove the price of energy up. The shutting down of the supply chain for COVID was another structural issue. You know, it's not like your new BMW will push to start. You shut it down, it doesn't start back up just because you ask it. And there's a lot of cross jurisdictional and country linkages that have been broken because of populism and nationalist tendencies. Um, During the shutdown of global supply chains is the worst time to try and go nationalist. It's also one of the reasons the worst time is because you need your partners, but if you are going to go nationalist, you need to do it before the supply chain shut. And if you do that, then you have more control over your supply chain as it gets shut down and it restarts. So what I saw was basically um, a perfect storm of the worst case scenarios multiplied across different sectors. A lot of talking. Did I answer the question? All those words, one of them had to answer one of those questions, right?
Yeah, the inflation is partly because there's more dollars chasing less products. You know, you have supply chain issues which are limiting the ability of products to get to the shelf, and more dollars being printed and distributed into the market. So it's a double whammy. In my opinion, the inflation problem is not going to get solved until we fix the supply chain issue.
And I didn't. I'm glad you brought that up because I didn't finish discussing um, the bi. I said it's not a bilateral binary solution or problem. The Fed is pushing. Number one, it's the Fed that printed all the money, and it's the Treasury that enabled the money, the monetary stimulus, and the Fed enabled fiscal stimulus. Okay, I always get that confused, but you understand what I'm saying. Um, the Fed is acting as if, okay, we flooded the world with US dollars. If we start soaking these dollars back up, we'll fix the inflation issue. But that does absolutely nothing to the structural issues and the supply chain issues. And that's what is being missed by many. You have to do both sides of it, and it doesn't matter how much you soak up the US dollars. You don't fix structural supply chain issues or the structural issues, period. As a matter of fact, as you start soaking up the US dollars and push interest rates up during a lackluster economy with structural supply issues, you force the economy to grow negatively, to shrink. That's when you handle stagflation, and that's why I made the stagflation call in 2000, very late 2000. Okay, I just admitted several people. So if I brought you on stage and admitted you, speak up. Okay, sing your song as of right now. Otherwise, Trey's back on the mic. Okay.
So I think Pedro just got his microphone going.
Okay. And microdob. Everybody, first unmute your mic if you don't unmute your mic to speak, because I Nobody can hear you if your mic's muted.
How long do you work there?
Okay, Mike Dobb, sing your song, my friend.
Wait, hold on. Can you hear me?
Yes, I can.
Okay. Actually, I have the gas man here. Let me continue listening, and I will come back to you.
Okay,
Okay. Sorry about that.
no problem. Pedro, anybody?
How's it going?
Oh, well, going well. Sing your song.
I don't have anything interesting to say.
Okay. Any questions?
Not yet.
Okay, well, fair enough.
So Reggie, I've got a question about your IP. I know that there are several industries which suffer from lack of capital from the inception of their business through to the final product. And one of the best examples that I can bring to the table is the gold mining and silver mining industries. They've got all of this value stored in the ground. And one of the biggest problems that they have is getting enough cash flow together to get their capital requirements, equipment, distribution lines, et cetera, going. Are there any industries that you pinpointed that you could tell the audience about that would benefit the most from your IP?
I think it depends on the execution of the management. I know that's a cop-out answer, but a lot of people focus on the mechanical linkages of conveying value from an operator to an investor. So that would be security, stocks, bonds, or a particular industry, whether it's pharmaceutical, crypto, financial, real estate. But value is created and expanded by management. So it really depends on the manager. And that really sounds like a cop-out, but it's also a fact. Once it comes to the mining industry, we actually have been in discussions for close to a year now with a group who own a mine, fairly prolific mine with proven reserves, and they approached us to basically use the Vaders technology, IP, marks, etc., to sell gold, to pre-sell gold using forwards, and a lot of very fancy ideas, create monetization lending programs, etc. And we're in discussions right now. Course, they don't want to do business in the US, which is a shame because several of them are US either citizens or residents, which goes back to the regulatory morass that we have. And it's a shame that all this IP, the private keys, wealth, and capital that is from the US is flying outside. But that's an example. I'm going to stop complaining about the regulatory morass now. Okay. Other questions? Anybody else up? Okay. There should be a lot of questions, but I would suppose not. I hear the chat is going. I can't look at the chat at the same time. So, Trey, if you could read any questions in the chat. I know there have been some questions about Twitter space that I had, which I didn't get to record because I was driving and talking at the same time, doing it off of my cell phone. But I said that I would explore and look into attempting to add value to the extent very tokens that have been sold to very token purchasers who are not bad actors. In other words, who have not given me personally or Veritasium entities or their contractors problems, didn't sue us, badmouth us, etc. And an idea that I came up with was to allow the very tokens to purchase custom-made NFTs. And those NFTs will have embedded in them the ability to discount licensure to pieces of selected Veritasium Capital's IP. They would be primarily using, I forget the name of the EIP, but it's baked into the Ethereum blockchain
EIP is
now.
4907, if I'm remembering it correctly.
49, I think it's 4907. It's all melding in. This
Well, the double protocol just came out with a NFT that you can import a contract into, and it's 30 lines of new code. And basically what it allows you to do is take a token, stake it, and have the NFT become a rentable NFT. In other words, you can stake it on a site and rent it out for a specific amount of time, and it has a specific purpose and value. So I think that's where you were going with that. I wasn't sure. I wanted to ask you that question. If it was kind of like the double protocol. I don't know if you've seen the double protocol website or the video, but it is a staking mechanism which allows incorporation of a contract like the very token in order for a specific purpose over a specific period of time.
I didn't read the double protocol, but we ran through the EIP itself. And the EIP basically gives role-based management, or it gives two addresses for control. So it identifies control with two addresses. So it allows Trey's address to pass ownership to Reggie's address at a certain date. And then there's a second date, an expiry date, that ends that control and passes it back to the original address, which would be Trey. So Trey can rent that asset or capital or IP or whatever it is, that token. Trey can rent that to Reggie for 1 calendar year. And at the end of that calendar year, the control goes back to Trey's address.
Sounds strikingly like the VE rent.
Exactly. It's exactly like the VE rent, right? Which is why and that is patented, that's covered under the patent. We luckily patented most of the stuff that we came up with. And with the benefit of hindsight, we came up with a lot of the stuff early, but all we did was solve the problems that we encountered just to build the product. So, a lot of it was luck. Now, we would use that 4907, I think you said it was. I posted on a Telegram chat. It's just I go through a lot of this stuff, so it melts together. We would use that to basically give certain Veritasium holders, without obligation, without warranty, without promises, you're not, obligated to do it, etc. We would allow certain Veritasium token holders to purchase, or not even purchase, to mint their own NFTs on their own, okay? And then that NFT would be able to access Veritasium IP discounts. And it would be up to them to both mint the IP with the contracts, mint the NFT with the contracts, and to negotiate with any potential consumers of discounts for the IP and negotiate the deals. You're doing all this on your own, so nobody can ever say that you're benefiting from the efforts and work of
So we
others.
automatically fail the Howey test.
From my perspective, but as history shows, I disagree with certain regulatory agencies. So that's just my opinion. And since I promised not to discuss that anymore, I'll land that plane right there. But
All right,
so always consult an attorney. Okay.
Well, thanks for the clarity on the very token. That's really exciting for the community to hear that. I do have one more question from TC98. Do you think privacy coins have a future?
Yeah, they have a future, but probably not the future that many people think. I was in communication very, very, very recently with federal law enforcement officials who were following up on my hack. I was hacked in 2017 for about $9 million. At the time, today's equivalent value was about 48 to 60 million. And I am under the impression that Monero might be broken already. And most of the mixers can be unmixed. Now, you've already seen that with them tracking down the Samurai, I think it was the Samurai mixer. But that was used improperly, and the mixer itself had some issues. But long story short, privacy coins might not give the privacy that most people think they do. And if they do, they have to be used properly. And privacy coins have been warred against by government agencies for what I would think would be obvious reasons. I'm not going to get into discussion whether it's good or bad. I obviously value my privacy and security significantly, but there's a lot to go into the argument. I know privacy coins are not traded up on the major exchanges. If we can get the mindset of using DeFi correctly and peer-to-peer capital markets, you don't need exchanges because the blockchain itself, the internet itself, is a large peer-to-peer exchange. All you need is buyer seller discovery. Then they post information, and then you have market price discovery, and that creates a market without a centralized exchange at all.
So in your opinion, centralized exchanges are going to become obsolete. All we need is a peer-to-peer offering and or a decentralized exchange offering in order to accomplish our goals.
Technically, they will be obsolete. Realistically, it may not happen. And also, we have to understand what we're talking about. A lot of what we call an exchange is on exchange, like Coinbase, Gemini, Kraken, Binance. Those are not exchanges. They're broker-dealers. They're broker-dealers and shadow banks. Now, I'm not saying they're securities broker-dealers or commodity broker-dealers, but they're still broker-dealers. You can look up the definition of a broker, of a dealer, and an exchange, and you'll see most don't fit the definition of an exchange. Exchanges don't trade their own capital. They don't take principal risk. These crypto exchanges do. Look at FTX. Okay. Anybody up? I see quantum crypto. Let's get some diversity in this conversation. Talk to us. Anybody? Okay, quantum crypto. If you don't want to talk, you mute your mic, use background. If you do want to talk to us. And anybody on stage, we have 8 people on stage and only Trey's talking. So if you have nothing to contribute, please step off. But I would love for everybody to talk. That's why we're here on this format. Okay? Okay. Any other questions from anybody else? Okay, Josh Silla is coming on board. If he does not speak, then I think I have talked everybody down. Josh, can you hear us? Unmute your mic and sing your song. Okay.
Reggie.
We got it.
Oh,
yes.
Go ahead.
Go ahead. Talk.
Oh no. Well, I just had long-time listener, a friend of yours from way back, and very enlightened by your knowledge of the market and the coin market and financial market, period. But one thing I wanted to ask you, coin market still has you, it still has this disclaimer, and I thought it was over for you with the Security Exchange Commission has filed charges against you. Can you legally have that removed? Because I think that prevents people from wanting to look at Vertasium as investment.
Well, that's been over for me since December 2019.
Right.
There are a lot of players in the space and entities who are not objective, who the card just don't want to see me succeed, whatever. I've moved past all that nonsense. Veritasium is now totally separated from the Veri token. So there's no way to invest in Veritasium. Even when we weren't separated from the Veri token, purchasing Veri tokens did not invest in Veritasium. You just purchased prepaid access to our products and services. Okay, so I want to clear that up. But the existence of that is disconcerting, unfortunately. But consider that a significant knock on the credibility of CoinMarketCap and anybody else who puts it there, more so than anything else. Okay, we don't sell anything except for our IP, and a lot of entities have purchased our IP already and just haven't paid for it yet. So I don't care what CoinMarketCap says and all the other entities who want to call us a scam, et cetera. If you take a look at our operating history and what we've accomplished compared to what was said about us by some very popular characters, and yes, I'll call you all out. Laura Shin, who does that podcast, Unchained, called us a scam in her book and in her podcast. take a look now. Nick Carter, very large following, so-called venture capitalist, called us a scam. Just because you have a lot of Twitter followers doesn't mean you know what you're talking about. And yes, they say a lot of negative things. I'm a grown up. I'm not going to sit here and argue and name call. Take a look at their assertions, the allegations, and then take a look at the facts and research the facts. You can't research facts from CoinDesk articles. You have to look at the actual primary sources and make up your own mind, come to your own determination. Okay? I'm not going to badmouth anybody. And the fact that someone is bad-mouthing someone else is an indication in and of itself. Long-winded way of saying, I don't care what they have. They should be ashamed of themselves. I'm not going to take legal action against them, at least not for that.
Gotcha.
You know, I may have discussions with their parent company, but that's for a discussion for another day. Yeah.
Reggie, there's some people in the know that believe that multiple hundreds of billions of dollars are due you for people that have used your property in the past. Do you see it that way? And I got a follow-up question after you answer that.
Yes.
Okay. So the follow-up question is from the Very DAO. One of the Very DAO members has asked a question. They said, do you think that CBDCs will usurp or take over stablecoins?
Yeah, most likely.
So does that mean stablecoins will eventually be a bygone thing? They'll go away?
Stablecoins will have a minority market share if they're not outlawed. Now, that's where USDC comes in. USDC has been making significant inroads in the governance of this country and the infrastructure, regulatory infrastructure. So they may be used as access to public chains. Maybe they may be used as some other function, but they're looking to be members of the club. Where Tether, which has probably twice, if not 1/3 more market share than USDC, is not part of the club, and I don't think they're as welcome in the government circles as USDC. Another entity is Ripple. Ripple has also made significant inroads, of course, not with the Securities and Exchange Commission, but they're making inroads legally with them as well, just not voluntarily. So I think Ripple may have something to do with CBDCs as well. I'm not really following it that closely. I'm following it from a different perspective in terms of technology and intellectual property. Okay.
So I think we have a question from BLA Quid.
Okay. And
Got a
Ron
hand
F.
raised.
Yeah, and Ron F., you have your video on. If you have a question, you can ask. Otherwise, you know, you got everybody staring at you in your living room. Okay.
Yeah. You talked about broker dealers. I'm in the trucking game, and how would you? I mean, I got an idea of how you would implement your IP into peer-to-peer transactions, but how would you see? Let's say, how would you implement it into the transportation?
Okay. So that's a big question. So I'm going to give you a snippet of an answer, and then, but I can't, you know, I won't be able to dominate the conversation with it. So the first thing that comes to mind with trucking and transportation would be communication and data. So a truck can broadcast its location, its available fuel, its payload value, etc., through encrypted means to other stakeholders. And depending if that truck is fully autonomous or driven by a human, you can trade that information with others to create basically a truck net. Think about autonomous Tesla trucks that can drive and they get stuck in traffic. And so this truck can actually bid to move ahead in traffic with microtransactions with everybody else around it. Okay, it gets stuck in some place that has minimal internet access, but there are many other Tesla trucks and many Tesla vehicles, period, or just electric vehicles. It could create an autonomous or instantaneous mesh network, okay, and communicate within that mesh network until it gets to stronger Wi-Fi area, internet access, or it could ping off of a proprietary satellite and then beam internet access there. These are examples, okay? Okay. So next up, whoever had their hand up, you saying was waiting, Trey?
Yeah, BLA Quid.
Yes. Hello, this is Blackwood. Concerning your patents, the elephant in the room for me is CBDCs, given the heavy-handedness of the SEC so far. How do we see or foresee the Fed engaging with you on fair terms concerning how the CBDC might infringe on your patent technology, especially given the fact that now we see Ethereum is about 70% OFAC compliant. Even Casa multisig, which was solely Bitcoin based, is now incorporating Ethereum. So we're seeing an encroachment that's challenging DeFi in almost every area. Do we really expect the Fed to capitulate or work with you fairly and other countries as well who might put forth CBDCs where you may have a patent pending?
Well, either they work with me or they don't. It's that is binary. If they don't work with us, then you go through the court system. Okay, it's really just that simple. The Fed is not a government entity. The Fed is a private corporation. Okay, so and federal entities, if I'm not mistaken, are still liable for patent infringement, unless the patent is has to do with the safety and welfare of the citizens of the country. And then you have what will be called compulsory licensing. They don't take it from you, but they force you to license it at market rates. As long as you're not trying to exclude from the industry, that's your goal in the first place. But if you're trying to exclude, you can't exclude the US. And even if you could, think of the fallacy in doing so. This brother in Brooklyn is going to challenge the US military into a fight. It's just not good business, okay? So just keeping that in mind. Once it comes to Ethereum and Bitcoin and multi-sig, DeFi, think of DeFi as widgets, just like a computer, okay? So something might not be decentralized finance, but they could use decentralized finance widgets. And that would be CBDCs, for instance, or Bitcoin, or Ethereum, or a centralized blockchain. So you don't have to be DeFi to infringe on a patent, because the patent basically has to do with decentralized finance widgets itself and not the entire mechanism. Hopefully I answered all your questions. You asked a compound question, and I'm getting to be an old man now, 55 and a quarter. See, so they don't always stick in the mind. So one question at a time. Next up, and I'm going to end this in the next few questions because I do have to get to work and get some work done. Okay.
I've got actually a two-parter question. One is the naming of the crypto exchanges versus broker dealers. Do you see that changing? Or actually, first question is why do you think they do that? And then the second.
When you say that, tell me, what is that specifically?
The naming of exchanges versus broker dealers. Why are they using exchanges versus the broker dealer nomenclature?
Okay, because most likely those who used it initially in chat rooms and discussion groups and in the media were just ignorant to finance. You just didn't know any better.
Okay,
So,
and then the industry
I don't
just
think
kept.
it's any malicious conspiracy. They just thought it was an exchange and didn't know what an exchange was.
Okay. And then second part is, with the dominoes falling of these exchanges, before FTX, but it seems like FTX is kind of accelerate things with their all the tentacles that they've kind of connected with so many other companies. Do you see that nomenclature changing after the what seems like it's kind of a domino effect to a lot of different companies? Do you see anything changing with the nomenclature going forward after that?
It's going to change, but not because of that. It's going to change because real exchanges are going to come and start buying things. Or if Contagion brings a lot of these entities down, they're going to start cherry picking assets out of them because it's difficult to build them from scratch for those who are not well versed in the industry when you could just buy them for 10 cents on a dollar because the extant industry players didn't know what they were doing and they created toxic linkages that didn't have to be there. And they made very bad valuation errors, which is what is rampant right now. So the biggest consumers, I think Trey asked this question earlier, the biggest consumers of the IP would be exchanges, money center banks, and the institutional fire sector. That's finance, insurance, real estate, with finance having subsidiaries of asset management, banking, lending, etc. Okay.
Thank you. Yep. Thanks.
Okay.
Reggie, it's Jeremy here.
Yes, sir.
How are you? Just following up on something you said a few months back about tokenized gold returning at some point. Do you have anything you can update us on with that?
I did update a little earlier, so I don't want to rehash the whole thing, but I am in discussions with the owner of a mine in the Americas, and the mine is prolific with significant proven reserves, and we'll see how it goes. Okay, they are raising financing, and we're doing other stuff. Nothing promised as of yet. If it falls through, we still may do it just with somebody else. If it doesn't fall through, when operations get to a certain level of maturation and maturity, we'll announce it. As it is, they don't want to do business in the U.S., but I may be able to talk to them differently.
I'm surprised that you would say that.
Surprised I would say what?
Oh, I'm sorry. I didn't know my mic was still open. I was speaking privately.
Okay. So be careful. Okay.
Yeah, you can.
Okay.
You can mute me, or can I mute myself?
You can mute yourself.
Okay, great.
Okay.
So Reggie, I've got another question if there's nobody else coming to the table here.
Okay.
So there's a member of the very DAO that's asking if your IP is broad enough for countries to wrap aspects of their gross domestic products under something like the NFT tokenization or direct peer-to-peer, government-to-government delivery versus product offering.
Well, that's very jurisdiction specific, not to mention technically a technical question. So impossible to answer that accurately. If you choose, say, the US, Japan, it all depends on how they want to do it, but it's possible. The IP just covers technology, methods of doing things and devices and systems. It's not magic. To make the IP work, you have to be an operator, a manager or executor, and it's all in the execution. We had some bad actors that actually tried to take the IP from me, take the patent, and they had no valid meritorious reason. They were just being greedy and unethical. But assuming they would have won, they couldn't have done anything with it. It would have been worthless to them because it takes significant managerial expertise and execution to monetize this stuff. And the level of expertise and managerial execution is beyond the vast majority of players, both in and out of the space, in my opinion. And if it really was that prevalent, then they would have patented it. That's my opinion. And I'm not patting myself on the back, because I benefit from the intersection of luck, expertise, timing, and intelligence, and or lack thereof. Sometimes I realize I'm not as smart as everybody else and I act accordingly, versus the hubris that you see in crypto Twitter, where everybody knows everything. My biggest advantage is I know I don't know everything. Okay.
So I think that there
Sometimes
was
humility counts.
there was a lot of talk in the XRP community about XRP being the next big settlement agent. And I know that in our analysis at the Very Dow, we've done some infringement analysis, or looked at some infringement analysis that says that the on-demand liquidity product that that the Ripple Labs has come up with infringes on your patent. Even though they've come up with a subsequent patent, yours has prior art. Can you talk about the power of your IP being that it is foundational, that it covers technology like on-demand liquidity from Ripple, it covers technology like JPM Coin, who is using that technology to do settlements, saving millions and millions of dollars versus the SWIFT system in Asia right now? I think the power of your technology is that everybody is going to be using digital peer-to-peer or entity-to-entity settlement is using your IP.
Well, I can't say everybody, but the on-demand liquidity is, plain on its face. If you read through the specs, the specifications in the patent and the examples, an example was given of a woman who had a business, and she wanted to receive crypto for payment. And it explains on-demand liquidity verbatim. Okay. I don't want to say it's Ripple's on-demand liquidity, because it's not Ripple's on-demand liquidity. It's Reggie's on-demand liquidity. But it explains on-demand liquidity as executed by Ripple, word for word. It's just that instead of saying XRP, it uses BTC. So that's something simple that any lay person can look at and see on their face and be like, wow, okay, well, this is on-demand liquidity. As for other implementations, I feel most of the major banks, most of the stuff they're doing that I've read falls under the patent, but I don't want to call undue attention to it so everybody tries to break it. There's one litigant that has going out of their way to try and break the patent versus negotiate with us. I don't think it's a good use of their resources, but it is what it is. We have machinations in place to deal with whatever happens. And I think the effort to avoid the patent versus simply just to pay and move on is empirically unwise. It's a polite way of saying it, right? I could think of a more direct way, but it wouldn't be as polite. So that's my opinion.
Great answer. Thank you.
Okay. Any other questions? We give the 10-second countdown, then we'll unwind and
You got a question, Rick?
Okay, go ahead.
Yeah. Let's say you had good ideas on how to, connect a shipper with a trucking company without a broker. Is there any type of software being developed, or is that something someone like me would have to hire a software developer to implement it into your IP to make it work, or how?
We were developing software that was killed by the SEC, but and we're not going to do it now because of the opacity and ambiguity of doing something here. But if you want to do it and you're funded, which is very important, contact us and we look into it. The letter of credit embodiment in the patent, if you go to the patent, the 566 patent, which you can find just by Googling Reggie Middleton patent and going to Google Patents, going through the specifications, do a Google search, do a what's the term? Keyword search in the patent for letter of credit, or LC. and read how that is done. And that's a perfect example, I think, of what you're talking about. So that just has to be coded. I would recommend a fully decentralized and distributed application. Could be very, very, very powerful, particularly
Ron,
once.
you
Excuse me?
you can also research delivery versus payment software. Delivery versus payment software is out there, and it does infringe on the IP. It could be, in my opinion, it could be improved if they involved Reggie Middleton, but delivery versus payment is I think what you're talking about.
Okay.
Okay. Anybody else? 5-second countdown. Going once, going twice. I'm going to cheat. 3, 4, 5. Bye. No. So thank you, everybody, for coming by. We have covered a lot. I don't know how long I've been online, and we have 126 people in the chat room. I don't know how well this did, but 126 is good considering it was impromptu, and I just sit down whenever I can. I've gotten a lot of requests for people to tell me when I'm going to go live, and you know something? If I knew, I'd tell you, but I don't know. I do it when I can. Um, Unfortunately, these are not things that I'm compensated for. So other things take priority, but I do like to communicate. And I thought it was my duty to correct the error that I made with the claim of rehypothecation. So I want to get that out nice and early. It's only 24 hours after the fact. I'm not going to take the other media down. I'm going to consider this media my viewpoint that supersedes that viewpoint from yesterday. Now, let's be clear. I did make a mistake, and I apologize for the mistake. I'm even calling Coinbase CE out personally and directly. But the mistake was in the machinations of how the risk is travels to the end user. It is not a mistake in whether there is risk that travels to the end user. So the very, very poor credit metrics of Coinbase and Circle, the pathology and the revenue model construction of USDC still stands, okay? But they don't rehypothecate. That risk is communicated in other ways. So I'm trying to be empirical and trying to convey knowledge in its purest form, and I'm trying to be accurate. So if there's a blow up, don't say, who would have known? Everybody on this video would know, okay? Anything in closing, Trey? Or you want to make an announcement for the very DAO, if there's any?
No, the very DAO is going to be coming out with our final analysis of our amicus curiae that we submitted before the court. We stand ready to stand up for any questions the judge may have about the plight of the very token holders and our support of the Veritasium platform. So be looking for the YouTube channel, some new stuff to come out, and join us in the very official room in Telegram to continue some very interesting conversations.
Okay, now there's a clone. Somebody with too much time in their hands has cloned the very official room, and they've copied the users and even the admins and mimic their name. It's a scam. They're phishing, trying to get user information. So be very, very careful to make sure you're into the correct room.
The scam
Okay.
The scam room has 2 L's on the end of official. The very official room has one L.
Okay. And on that note, I'd like to applaud VeriDAO for the amicus brief. It was very well done. Communicates, the message efficiently, and I think it's probably the hardest hitting of all 14. I think 14 amicus briefs, because
16 total.
16,
Yeah.
16, because it doesn't just discuss and argue the law, and it doesn't give hypotheticals, even though those hypotheticals that were given are very plausible and likely to come to fruition. It gives actual historical fact of what happens when SEC enforcement gets their way in draconian moves. So it tells the judge, this is what happened, not what we think would happen, not what we want to happen, or not what the law says. This is actual historical fact. Very, very powerful. Kudos to them. I am not a member of the VeriDAO, okay, but of course I do have vested interest in what they do and how they perform. Okay, full disclosure, full transparency, or at least disclosure and transparency. You don't go full because I'm a private entity. Okay, so on that note, I bid you all adieu. Thank you very, very much for your assistance, Trey.
Yes,
Next
sir.
time
Thank you for your words of wisdom today.
we need to do this in a more concerted effort. So I don't start the video looking how to get things to work. So, okay. Goodbye, everybody.
Thank you.
Thanks, Reggie.
Okay.